Hi everybody, and welcome back to video number 5 in chapter 15. And when we left off, we were looking at a summary of the option activity here. And the arithmetic down in the second and first paragraph here, I'll let you work through that arithmetic on your own. And as it's a little time consuming, but I don't think it's terribly difficult, and you should be able to handle that. Okay, so let's move on. And here we're going to be looking at restricted stock awards. The company also has a restricted stock plan. The plan is intended to retain and motivate the company's chief executive officer over the term of the award and to bring his total compensation package closer to median levels for chief executive officers of comparable companies. The fair value of grants during the year was $1,889,000 or $35.68 per share, equivalent to 92% of the market price of a share of the company's common stock on the date the award was granted. So if we look at the activity here, our shares, what we have would be outstanding as of December 31st, 2024, what we've granted, what's been vested, and what's been forfeited, and our total outstanding shares at the end of 2025. It does show when we granted what the price of $12.68 was for that 149,000 shares. Okay. The following are transactions that the Hardin Company is evaluating related to compensation for its employees. 1, we're going to issue 100,000 shares of restricted stock to its employees, and on January 1, Hardin will not permit the employees to sell their units over the vesting period of 4 years. The employees must stay within the company for 4 years. Otherwise, the stock is forfeited. So let's look at the journal entries for January 1, 2025. Under Alpha, here, we're going to debit unearned compensation. That's the $12 times $100,000, $1.2 million debit. And we will credit common stock at its par value for $100,000 and the paid-in capital of $1.1 million for that differential. Now for 2 and 3 under Alpha, we won't have any entries. Okay, so now number 2, we're going to issue 1 million stock options to its employees on January 1, 2025. The fair value of the options is determined to be $2 as determined by the Black-Scholes option pricing model. The exercise price of the options is $13. The options will vest over 4 years, so the service period is 4 years. Let's take a look at that. So under Bravo, we're going to, this will be the end of 2025, we're going to debit compensation expense for 1/4 of that $1.2 million, or $300,000. And the credit will be to unearned compensation. Now, under 2, the compensation expense is going to be 1 million shares times $2 divided by 4, or 500,000. We'll take that to compensation expense as a debit and a credit to paid-in capital stocking options for 500,000. And then we'll debit compensation expense here for 288,000. That's going to be $12 times 120,000 divided by 5. And then paid-in capital on restricted stock units will be 288,000. Now, under 3, we're going to issue 120,000 restricted stock units to its employees. Did I miss that? Yeah, no, I didn't. 120,000 restricted stock units to its employees on January 1, 2025. Vesting occurs after 5 years. If the employees fail to stay with the company for 5 years, the stock units are forfeited. So let's look at that one. Again, the par value of the common stock is $1 per share. Hardin's share price as at January 1, 2025 is $12. Its share price at the end of the year is $8 per share. Okay, so under Charlie here, cash, we're going to debit cash for $13 million. That's $13 times a million. And then our paid in capital is going to be $1 times, paid in capital will be $2 million. Common stock will be $1 million here. And that's $1 par times a million. And then paid in capital in excess par for $14 million. Okay. Now, under delta, we're going to prepare the journal entry as of January 2nd, 2026, if one of its employees holding 2,000 restricted stock units resigned as of December 31, 2025. So if that was the case, we need to back out the restricted stock units of 4,800. That's going to be 2,400 times 2, I think. And compensation expense is going to be $12 times 2,000 divided by 5, or 4,800. And that's the proper calculation there. Okay. Let's take a look at basic earnings per share. Basic earnings per share is pretty easy, and I think you've had this before in your financial accounting classes. The earnings per share indicates the income earned by each share of common stock. So the companies report earnings per share only for common stock. So our net income was $300,000, right? And so our earnings per share of 100,000 shares would be $3 per share. Now, when the income statement contains intermediate components of income, such as discontinued operations, employees should disclose earnings per share for each component. So, income from continuing operations is going to be $4. Maybe you have a loss from discontinued operations. Notice too, it is net of tax. So these are after-tax numbers here. So $4 is netting, is going to be after tax, 60 cents is after tax, and $3.40 earnings per share is going to be after tax. Okay, simple structure of basic earnings per share. Here we have common stock and no potentially dilutive securities. It gets a little more complex structure when it includes securities that could dilute earnings per common share. And you'll remember, dilutive means the ability to influence the earnings per share in a downward direction. Okay, so our basic arithmetic for calculating the basic earnings per share, we need to subtract out the current preferred stock dividend from the income to arrive at the income available to our common stockholders. The common stockholders don't get preferred stock dividends, so we subtract them out. So the arithmetic here is net income minus preferred stock dividends. And then this is the weighted average number of shares outstanding. So if I were to have 100,000 shares on January 1, and then I issue another 100,000 shares on July 1, that would take me to 200,000 shares at July 1. Our weighted average number of shares for the year is going to be 6 months at 100,000 shares and 6 months at 200,000 shares, which would mean our weighted average is 150,000 shares. And that's what we would use in computing the basic earnings per share. Current year preferred dividends are subtracted on cumulative preferred stock, whether declared or not. The dividends. Okay, weighted average number of shares, as I illustrated in my example, during the period constitutes the basis for the per share amounts reported. Companies must weight the shares by the fraction of the period they are outstanding. Okay, so here's a weighted average outstanding illustration. Frank's has changes in its common stock outstanding for the period. So here's our beginning balance. They added another 30,000. They add another purchase back shares for the treasury. They issue another 60,000. So the ending balance is 141. So how would you compute Frank's weighted average number of shares outstanding? Pretty easy, really. You would compute the fraction of the year that each of those outstanding shares are kept, and then multiply them all through to get 103,000. Okay, so as indicated, 90,000 shares were outstanding for 3 months, and that's equivalent to 22,500 shares for the entire year. And so, et cetera, et cetera. I think you see how that works to get to 103,000 weighted average number of shares outstanding. Okay, when stock dividends or stock splits occur, companies need to restate the shares outstanding before the stock dividend or split in order to compute the weighted average number of shares. So the companies restate the issuance of the stock dividend or stock split, but not the issuance of repurchase of stock for cash. All right, here's an illustration. Acctg Corporation had 100,000 shares outstanding on January 1, issued a stock dividend on January 30 for 25%. No other common stock activity occurred for the rest of the year. How would you compute Acctg's weighted average number of shares outstanding? So for the purposes of computing weighted average for the current year, Acctg assumes the additional 25,000 shares outstanding as a result of the stock dividend to be outstanding since the beginning of the year. Thus, the weighted average for the year is going to be 125,000 shares. Okay. Now, if we have stock repurchases, we're going to have the following shares outstanding and repurchased as we did similarly a slide or two ago. So how should they compute the weighted average number of shares here, recognizing we had this 50% stock dividend? Well, we do the same calculation. We restate these back as shown to 180,000. So it must restate the shares outstanding prior to the stock dividend of 50%. That's accomplished by multiplying the outstanding shares by 150 by 1.5. So it does not restate the shares after the stock dividend because they are on the new basis. And that's all we'll do for this video. And when we return, we'll carry on. Until that time.